Hey everyone, welcome to Blue Dragon Universe. This is the Blue Dragon actual channel. Although I am thinking of releasing this video in my trading channel as well because it's a overlap. Although for my trading channel, I usually record videos in Hindi, but this video obviously would be in English because it is kind of made for the actual audience predominantly. But I think this can also help my trading audience, and I hope they would be able to understand this, right? So this is a video on quantitative finance. I have, in my LinkedIn profile, I have received, what can I say, maybe more than 1,000 queries on quantitative finance. Different point of time, different people have different thought process, and some people considered asset liability management and quantitative finance. Some people consider maybe trading as quantitative finance. So that's where I believe that deep knowledge on quantitative finance is required to understand, what exactly is quantitative finance. And I hope if you stay till the end of this video, you will have exact understanding of quantitative finance is and how it can benefit you, right? So as I mentioned, it is created from the perspective of giving knowledge to the actuarial students. Since I have also cleared my last paper in SS7, which is the trading paper or the investment paper, although I'll be clearing the life insurance paper as well in some time in the future, right? So without further delay, let's move on to further kind of understand what is quantitative finance. So it involves the use of quantitative methods. Methods means math, stat, right? All of those like mean, median, mode, kurtosis, skewness, etc. All those statistical things and more than something more than that as well to model financial instruments. Now, this modeling of financial instrument is very, very important. Like the price of equity, right? But how you know the price of equity? It's based on a fine mathematical model, right? It might be cash flow discounting method or some other model, right? But that is how you can give a number to a financial instrument. Now if you have your own model, if you have your own mathematical model by some way, I am not going into the details of how you can create such model, but if you have your own data by which you can maybe create your own mathematical model which can create a price for the instrument, and you can determine whether this instrument is overpriced or underpriced. If it is underpriced, you can purchase it. If it's overpriced, you can sell it, right? So that basically means quantitative finance. Like you have to use the data to come to a price, right? That is the data is your input, the price is your output, right? That is basically the you can say the entire summary of quantitative finance, right? At the same time, you have to assess risk, and based on, like I mentioned, if it is underpriced, if it's overpriced, based on that, you can make your trading and investment decision. So I believe what exactly we are doing in quantitative finance, that is clear to you, right? Now it needs knowledge of maths and stat. And when I speak about statistics knowledge, I believe many people have superficial knowledge. So you cannot have superficial knowledge. You need to understand probability distribution. You need to understand continuous and discrete, right? Then ANOVA, one-way ANOVA, two-way ANOVA. You have to understand all of those. If you have not understood that, then your knowledge is superficial. Same goes for mathematics, right? You need to understand continuity, differentiation, derivatives, right? And the spaces, the planes, right? Difference between a line and a plane, circle, sphere, etc. All of these things should be clear to you. If it is not clear to you, you are going to struggle, because from the concept of limit, continuity, differentiation, we come at the concept of stochastic calculus, right? And stochastic calculus is used for where there is time and probability involved. Like you cannot just say that this is what is going to happen. There is no discretionary thing involved, no matter how much you kind of reduce the time. And probably in the later part of the presentation, I can give you a better example, right, of stochastic calculus. But it depends on probability. Wherever the output depends on probability and time, so then we use stochastic calculus, which is the case for stock market, because it is based on Brownian motion, right? There is no, it is random. The movement of the price is random, right? So that's what Brownian motion says. You need a lot of coding, which is also needed in Actuary, and real hardcore knowledge of the live market trading experience. Now few people think that finance is theoretical. That is not the case. You need hardcore live market trading experience. Otherwise, you are, whatever you are going to theory, based on the theory, whatever you are going to create, that will not be sufficient, right? Your model will never pass the test of that test and validation test, where you see, where you are kind of using some training data and you are trying to assess whether your prediction is as per the standard. It comes within a particular tolerance level, right? So for actual student, you should be aware, like we make projections based on assumptions, and then based on that we calculate the reserve, right? And we believe that this reserve is sufficient for the liabilities. But what if that reserve is not sufficient for the liabilities, right? So there is always that question of error, right? Same happens for the recently Institute of Actuaries of India conducted a seminar on Duckworth-Lewis method. I have not attended the seminar, but I know about that method. So there is also that chance of error, right? So in quantitative finance or in any prediction problem, our method or model should be able to reduce that error, right? So if you have used linear regression, there is something called MSE, minimum square, right? Minimum square expectation, I believe, and then you have to reduce that as far as possible. The lower the value for that, it means your prediction is making sense, right? Moving on. So primarily it is used by HFT firms, which is high frequency firms. We'll come to what is high frequency firm for arbitrage trading. So whenever there is mispricing in maybe a financial instrument like I mentioned, and that mispricing may last only for few seconds, right? So high frequency trading firm means they will come, enter in very huge quantity of data, huge quantity of maybe huge quantity of the financial instruments, right? Maybe 10,000 quantity or maybe 1 lakh quantity, and just hold the trade for a couple of seconds, make only one tick or 1 point, right? So 1.1 lakh quantity, 1 point means 1 lakh profit, right? And they will just exit in maybe 0.001 second, right? You and I cannot do that because we do not have the necessary infrastructure to do that, right? It is costly. Probably that would require us 2-3 crores to kind of create such firms, right? And get such advantage. And we'll see in detail what HFT firms or high frequency firms do, right? So they just play on the buying and the selling data. If the number of buyers in the market is too high, right? So then the market is going to go up. Now, suppose you are putting a very high order of sell, right? You know that you can manipulate the market. You have the power to manipulate the market. Then suddenly the stop losses of all these buyers are going to get triggered, and then you can make some good profit, right? And then you can also exit that buying position in the cash market, and you also made some profit in the derivative market by purchasing a put option or maybe selling futures. So this type of trading is done by high frequency firms, and we can see that in more detail later on in the slide. So this is similar to Actuary. Like, this is the main question that I get: can we pass SS7 and work in quantitative finance? The answer is no. The knowledge that you get in SS7 is very basic level knowledge. I believe out of SP5, SP6, and SS7, these are the finance paper. So for those, I think SP6 is the toughest paper. Not SP5. SP5 has outdated syllabus, so that is in any ways we would not use that in practical life. SP6 has good syllabus, which is, if you have done FRM level 1, so SP6 syllabus is kind of closer to that. And then SS7 is once again slightly outdated syllabus. So knowledge of this three subject is not going to give you any edge in quantitative finance, right? So the knowledge that is required in quantitative finance is 20 levels above this combined knowledge of this three subject, right? There is just no comparison. So we'll see further what are the disciplines and how we need to kind of improve on those knowledge, right? So who gets hired? Usually, definitely not actuaries. And one of the other reason for this is people who are working here are usually from a different domain than actuaries. So they do not have idea about actuaries. So that's why they do not hire actuaries, right? It's not that actuaries cannot be hired, right? We definitely come with at least the basic skill set. But they do not hire because they come from a different background. So obviously they will hire people from that background, not from our background. Moving on, few of the firms are Renaissance Technology, which is Jim Simmons. No, Jim Simmons is my idol in trading. I have seen a lot of stories, and there are multiple things that he have never given up his mathematical model. But I believe that I thought that one day I would be able to meet him, but he is no more. So hopefully, wherever he is enjoying at the time. And thanks for all the motivation, Jim Simmons, sir. Moving on, then there is D Shaw. This company is present in India. When I was in St. Xavier's College, Kolkata, in my graduation, this company came for kind of placement. I was not selected there at that point of time. Jane Street. If you are trading, you are very, very popular. People are blaming everything on Jane Street, Jane Auntie, Jane Amma, everything. So all the memes and jokes are flowing on Jane Street, right? Sometimes I also use the name of Jane Street. And then jump trading, right? So this is another firm which uses the quantitative finance, and you can Google about this firm. You can learn more about this firm, right? Renaissance Technology today, on today's day, or maybe a couple of years back, they do not accept any further, or there is no infusion of fund. It is just for the employees who are working there, right? So they have created a closed group. They do not want the algorithm to flow to others, right? They have a very strict restriction on that, right? So they would not hire you, they would not take your fund. That's how they are working. Obviously, D Shaw, Jane Street, Jump Trading, these are, they are already kind of hiring, right? And they are also growing. So you can look up for these firms in Google and you can understand what they are doing. Right. So moving on, usually who are hired? Usually PhD holders in math, stat, computer science are hired for creating algorithms, right? So they would give the mathematical basis of something, right? So in this case, probably if you have the ability to create something like Black-Scholes formula, right? Mathematically, it has to be competent enough. Then only you will get hired, right? And you will get hired at a huge salary. So there is no even I mean, for actuaries also, these salaries are like out of range. Like they very few people would have that background. Today we when I interview people, people cannot explain reserve or cannot explain differentiation continuity. How can you believe that such people would get hired for creating algorithms? You need very deep knowledge in maths and stat. That's why I mentioned at the start that superficial knowledge will not work here, right? Because here you need to create the mathematical basis of your model, right? And then you need to understand everything, right, of the trading. So it's a very difficult and concept oriented process. Somebody like Jim Simmons, who was a mathematics teacher, he was a PhD in maths. So some person like that can create something like this. Otherwise, you can only use something which is created by others, and that is not what these firms are hiring you to pay you for, right? Moving on, in India, usually the IIT and IIM degree is preferred because IIT will give you that age of coding. Although not many IITians that I've seen can actually code well, but few are exceptions, and that's where your power comes. And also IIM degree, because most of the people, as I mentioned, who are holding higher levels in this sort of firms, they are usually IIMs. They are usually from IIMs, and I think you can probably also Google, there are a couple of YouTube videos on quantitative trading. They teach you what to say in the interviews, right? So you can also see those if you are interested in this. So usually people from IIT and IIMs are preferred because coding skills are very important. It's not that you cannot crack these interviews if you're not from IIT or IIM, but if you have those, you know, designations or degrees, then it is helpful, especially in India, because in India we are a very designation and degree driven society. Right? Till now, we have not become a society like US where degrees do not matter that much. But in India, because we have higher population, we have to kind of segregate and filter people in some way, and degrees help us in doing that. Moving on, what are HFTs, right? So this is where we are going to go into detail of high frequency trading, because they are the firms which have maximum uses of quantitative trading. So high frequency trading firm, as I mentioned, they uses the buyer and seller data, and there can be multiple levels of data. One is called level one, low level, high frequency, high level, medium level, right? So there are multiple levels. You can see probably 20 lakhs buyers. I'm just giving example, 20 lakh buyer and seller data, and then you can determine what they are doing on and much deeper level data. You can see much lesser data, and also like even in Zerodha or other broking app, if you click on the market depth, you can see some the details of buyers and sellers. So those, that is the lowest level of the high frequency trading, right? So that is the lowest level of data that you are seeing for free, but you can actually purchase the data from the exchange, right? And that is where it is out of league for normal people like you and me, where we have to spend a lot of money to get those things running, right? So high frequency trading companies are companies that use sophisticated algorithms and powerful computers, right? So you also need a calculation engine. It's not that you can create the algorithm and that's it. You need also powerful computers, right, to process that, to execute large number of trades at extremely high speed. And actually, any these days algorithms, you can have algorithms which can operate on very high speed, but for that you need the data faster. You need access to the data faster, which is something is given by exchanges, which is called co-location. So you can, you have to purchase co-location from the exchange, and once again, that is a very costly affair, right? So it goes in crores. So you can, I mean, there are some other restrictions on you as well. Like as a retailer, I believe you cannot purchase that. So you have to register as a firm, and only then you are eligible for that co-location. So that is also very, very important, right? So you need that money power, and along with that, you also need the brain, like forming mathematical algorithm to, kind of identify the mispricing. And as I mentioned, the mispricing in price, maybe Axis Bank, which is trading right now maybe at 1200 rupees. Do you know that for the next 5 seconds, my mathematical model is showing that it is 1200, and right now it is 1200, and my mathematical model is showing it is maybe 1198. So I'll trade for that 2 rupees. So there is no risk reward, which people, in especially in the trading community, they say risk reward, right? So that there is no risk reward. This is purely based on accuracy. I will go ahead with 2 lakhs quantity. I'll just trade for maybe a couple of seconds, in which, because of the signal that is provided by mathematical model that I have created, it shows me that there will be 2 rupees mispricing. I will capture the 2 rupees, right? And I'll exit the market with 4 lakhs profit in 2 seconds. And then I can come back in social media and brag about that, saying that, hey, I made in 2 seconds I made 4 lakh rupees, right? But people who actually do this do not brag in social media. We know that, right? Uh, People who actually want to brag are people who are never going to get to that level. So that's how social media operates. Moving on, this firm take advantage of tiny price discrepancies in the market, which I have already, kind of explained, right? And use that, the arbitrage and co-location, which once again I have kind of explained. Right. So moving on, they use their own models. Like for that, that is the reason they hire PhD holders in maths and stats, and they use high-speed execution algo, not logic algo. Now there are two types of algo. You can, one of the algo can create signals. That algo will, kind of interact with the execution algo to execute the trade. Right. So it is not a logic algo. It is not for creating signals, right? And like if you have seen my trading channel, in my currently in my LinkedIn page, I am doing a 30 days challenge, so I am sharing my trading videos every day. You can see there are multiple, indicators that I use. So I have coded a couple of indicators myself in trading view. There is a coding language called pine script. I'm still in the learning process. I'm doing so many things that I have not got chance to kind of develop that yet. But you can code your own indicators that will give you signal. So that would be the logic algo, right? But when that signal gives you buy signal, then you need to use another algo to kind of execute that. You can have a combination of both this in the same code platform as well. It will be a combination of logic plus execution algo. But there are two parts of it, right? So your mathematical algorithm would give you the signal. Your execution algo would execute that signal, right? So these are the things that are done by, kind of HFT. Now coming to who uses quantitative finance. So obviously, prop trading desk, which is proprietary trading desk, hedge funds, HFTs, and there are multiple more players, right? But they are the people who have fund, who have brains, right? And only those people can use quantitative finance, right? It's not for everyone. You and I cannot use that until unless I open up a firm, right? Okay, moving on. Why is it useless for retail traders? I have already given you the reason. It is very, very costly. It requires a lot of money to create high-speed execution algo, right? It also involves manipulating the market through cash and derivative segment. I've already given an example, and in the later part of the presentation, we're also going to see an example. You can also spread news like Hindenburg does. Hindenburg is the short seller. If you are in the trading world, recently they have put allegations against the Savvy chief, which, as per me, is very credible. I've seen the allegations, but Indian market has not reacted to that. Even the finance ministry has said that they are not going to work on that, and that is very, very surprising for me. But anyways, that's how sometimes India behaves. So in last few years, the use of AI has also increased to generate signals. Retail can also make use of AI. right, to generate signals. In fact, I have a indicator. I follow an indicator which generates signal like that. Though I do not use that for trading. Recently, I was trying the crypto market, doing some paper trading because some SEBI regulations are coming, and I was thinking that can I use the crypto market? So there I was using that AI indicator. So you can also use such AI based indicator. You can also create your own AI based indicator. You have knowledge of AI, right? But right now that use is, you can also say that mathematical models that is kind of used in this forms. Those are also applications of AI, right? So you can also say that. Moving on. So discipline of quantitative finance, like where you need your skill set, and this is where I have got those thousands of questions in LinkedIn. So first is mathematical modeling, which is kind of similar to Actuary. Quantitative finance relies heavily on mathematical model, right? But as I mentioned, here you need deep knowledge of maths. You do not need the application of maths. You need creation level in maths. And very few people I have seen in my life who has that knowledge, who understand the difference between limit, continuity, complex analysis, real analysis, right, and number system, etc. Very few people does that. I am a maths owner, so I do, luckily, and because I spent a lot of time there, and I love that. I love that part about mathematics. But very few people today. I was talking to a fresher a couple of days back. I told them, can you use third bracket, use first bracket? I was surprised that she was not able to understand what is first bracket and what is third bracket. When I mentioned square bracket, she was able to understand. So if this should be very, very clear to you, right? This lingo of maths, this should be very, very clear to you. If you cannot understand that, then you will have problem understanding closed set and open set. So, I mean, you need lot more strength in your knowledge if you want to enter into quantitative finance. Superficial knowledge, like how we have in Actuary, because Actuary is a application of maths. Actuary is not creation or pure maths. Basically, Actuary is not pure maths. Actuary is application of pure maths, and that's where we can survive without knowing too much of maths. But if you want to actually create mathematical models, you need deep knowledge of maths, right? And nobody starts from scratch. There would be some models that is available, and you can kind of use your knowledge to kind of tweak it to your need. But tweaking that is not easy. It's that requires a lot of understanding of the underlying mathematics. Moving on, statistical analysis, also time series analysis, which is kind of written here. And you have already probably, as an actual student, you have already gone through regression analysis, time analysis, Monte Carlo simulation. Once again, Monte Carlo simulation, one thing that very few actual students understand. I This is one of my favorite question that I ask in interview. I ask people to explain Monte Carlo simulation and the blank. I can tell you 99.99% people today who is listening to this video has no idea about what Monte Carlo simulation is, although they might have cleared that paper. All right. So Monte Carlo simulation is very, kind of synonymous with this quantitative finance, because you are kind of always simulating, trying to understand what the market is doing. There's so many simulators in the market as well. I use TalkMock. There is something called Opstra. Those are also simulators, right? So you need the simulations. And these days you can also, if you have a simulation platform, you can also earn very well. Like I believe the StockMock is the thing for future. This company is going to do well in future as well. And Opstra will go away because Opstra is not keeping up with the future trends. So if you understand Monte Carlo simulation, you can create something like that as well, right? So that is very important. Once again, superficial knowledge will not work here. Moving on, derivative pricing. So if you understand Black-Scholes model, stochastic calculus, then also you can create your own model for derivatives, and that is where that mispricing and everything comes into picture, right? So that is also important. I think that you should understand, and obviously you need a lot of coding to create those algos, right? You need coding to create signals. You need coding to create executions. So I think all of this should be clear. So these are the four areas in which you need to develop your knowledge: maths, stat, and then stochastic calculus, very important, and algorithm, which is the coding part, right? So we are going to touch upon each of this, each of this part. So a bit on stochastic processing. So stochastic processing, as I mentioned, refers to the analysis and modeling system that involves randomness or uncertainty, which means like in if you understand the limit and continuity concept. So what mathematics says is, if you split, like if you continue to zoom and continue to zoom in and zoom in, so there'll be a very, like when you zoom in extremely deep, then what math says is then even a circle would appear as a straight line. And if it appears as a straight line, you can calculate the distance, right? So that is what the concept of limit, continuity, and kind of differentiation is based on. So limit says that if that distance is very small, right, very small, right, and because you are because you are considering that as a straight line, you can calculate distance, because you cannot calculate the distance for a circle, right, or a sphere. You cannot calculate the distance. You can only calculate the distance for a line, because it's a straight line, right? So that's why you are zooming in and zooming in and zooming in and going deeper. That is where the maths comes into picture, or the assumption comes into picture. And you say if this distance is very less, then this is how this is the value of the function is, right? And then you move from limit to continuity, that if this distance is very less and if it lies within a particular range, then this would be the value of the function, and this value would be present throughout this distance. That is the concept of continuity, from which differentiation comes into picture. So if you have trouble understanding what I've said, then your mathematical concepts are poor. Your concepts of real analysis, complex analysis are poor, right? So that's why you have not understood me. And if you are good in maths, then you should be able to understand that with clarity. So that is what is very important. Stochastic processing says that, or Brownian motion, what it says that no matter how much you zoom, right, it will still be a curve. You can never come to a straight line, right? And that is why we need different type of calculus, which we call stochastic calculus, or also known as stochastic processing, right? So it involves both time, right, and probability. It involves time and probability. So at different point of time, there will be different probability. Like maybe for same pattern, if there is same pattern that is existing before, which is also where the Markov chain concept comes into picture. If you are my trading audience, obviously this might go above you, right? But actual people will understand. So Markov chain means your current movement depends on only your previous movement, right, and not on your history, right? So in this case, your current movement might be extremely different, although you have similar movement in past, right? And on a different time period, it will be very different. So that is where the Markov chain, the stochastic process, and the stochastic calculus comes into picture. So all this you need to understand if you want to kind of work in this domain, right? Then it is used to understand Brownian motion mathematically. I have already explained this. Brownian motion means no matter how much you zoom in, you are never going to get that straight line, right? And in the insurance world, stochastic run is also used for valuing financial guarantees, which is also sort of thing that is related to the stock market, right? They use the concept of financial arbitrage and stochastic run to value the guarantees, right? So I have made multiple videos on that. In fact, in Sparkle One, which is my actual science course, right? If you have not purchased it, then you have missed a lot of things, and probably you're struggling with your life insurance interviews, actual interviews. And for that, this is very important. Sparkle One course. You can check the link in the description. You can go into the actual course and you can purchase that. And obviously, probably you'll know that I'm a qualified actuary. Like I mentioned, I work as an associate director in Moody's, so work at a fairly senior level, and I have created those courses. It is not created by anyone else, right? Anyways, coming back. So in an insurance world, stochastic runs are used for valuing financial guarantees, right? So that is how the trading and the insurance world can be related. And as you probably know, predicting mortality and lapse are much easier than stock market. And I am not saying that. In SS7 book it is written explicitly. It is written. So do not create controversy over this. This is written in the book, right? So SS7 has way more applicability than SA2. So I am lucky that I've cleared more. What can I say? More diverse paper. But obviously, because I work in the life insurance sector, I have to, though traditionally right now you cannot say that I work in any particular sector. My role is completely non-traditional, but I believe that clearing SA2 is also important, right? Because that is something that I was not able to clear. And I feel that if I let it go, then there will be a weakness whenever there is a weakness. And if I don't work on it, it is going to bite me in future, something like financial guarantees. So I have to kind of clear that in future, right? So this is an example of weak, or maybe an weak examples of quantitative trading. So few people, probably if you are from the trading background, you have seen people create strategies on option chain, I have also received comments on my trading channel saying, sir, option chain के बारे में बताइए, समझाइए. So this option chain data is 3 minutes late, and I don't think you should use option chain. So that's why I never said anything about option chain. And I have explained option chain in my basic course. So if you are completely, you do not have any idea about what is option chain, right? And what is open interest and what is the difference between open interest and volume, you should purchase my basic course in trading, right? Once again, that is present in the same website. So it depends on you if you want to learn about that. And you can also gather knowledge about that. But if you use option chain data to trade in some way, right? So then also you are using quantitative trading or quantitative finance, right? So that is a weak example because this data is present with everyone. This data is also 3 minutes late from the exchange. So you are working on a delayed data. It may not help you. But I have seen many strategies people uses option chain for multiple strategies. So this is an example of quantitative trading or quantitative finance. Another example that we commonly use, and probably you are very, very familiar with this, is known as price action trading, right? Many people will be, kind of able to understand this if you are in the trading world. And I have given an example here as well. Here you can see this is the Nifty chart of the last week actually. It was going quite bullish till this point, and then suddenly there is a movement. This movement came due to Reliance annual general meeting, right? So that is the reason this movement came, and within couple of minutes the movement also went up. So this is the manipulation that I was telling about, right? So if you know something, like there are many people who are in the, if you have access to the data, you know that many people are bullish right now. You create a candle like this, right? The moment you create a candle like this, the people who are here, all their stop losses would be hit, right? Now probably these people have switched into a short position or selling position, right? And then couple of minutes later you again move up, because steady, this movement was not based on any fundamental reason. It is just hunting the stop losses. So this is how HFT firms can also work, and because they have access to the data that you do not have access to, right? So that is why price action is also a weak form of quantitative trading. It is not a strong form that is widely propagated. People say price action is the king, price action is god. No, it is not. There is nothing like that. There are things who more powerful than price action. Price action is probably the weakest form of trading, but because we retailers do not have access to data outside, and that is why we have to settle with price action trading, right? Moving on. So these are the, what Python modules you need to probably understand, and probably you need more than this, but I've given you a summary, which is probably enough, but then obviously you keep on increasing. And Python is a slow language. So you can also probably create something on C++, which is much faster, right? But Python is more widely used than C++ because it has wide applicability. So if I have to create my own algos, which once again I learned, uh, and probably next year, this is something, Pine script coding and Python language, this is something that I'm going to kind of concentrate upon. Right now I'm more focused on the AI part, right? But then next year probably this would be my focus. But in Python module, these are the, maybe the modules that you want to understand. First is data crunching, which happens in NumPy and Pandas. Probably everyone know about this. Then comes the data expressing, means graphs and charts and everything, where you require Matplotlib and Seaborn and Printer. Matplotlib also used in AI part. Then we have level 3, which is AI, for which we require scikit-learn, TensorFlow, and different things are coming. You can also have OpenCV for visual, like computer vision and everything, to understand the pattern. So I have not mentioned that, but you may need knowledge of that as well. And then finally, for creating the algo, you have backtesting.py, technical analysis or TA, Django Flags for web scraping, and kind of connecting the webhook of the brokers so that you can, execute the trade, right? So all these are required at this level of. And if you are following us, if you are associated with Blue Dragon Universe, slowly and steadily you are going to bring each of this module in extreme detail and depth, right? And that is where we have to work very, very hard. But we are going to bring all of this module in extreme detail, right? So do not worry about that. If you want to create your own knowledge, obviously you can start today. But if you want to wait for us, then, do not worry. We are working on this, right? And we're going to bring this risk management. Of course, I'm not talking about actual risk management. right? So what I'm talking about is risk management mainly for execution. Like what if you stops getting data, someone in your team punches a very extremely risky order, or maybe instead of 1 lakh quantity, that person punches 10 million order, just a matter of zeros, couple of zeros, entered couple of extra zeros. So what would happen in such cases, right? So you need risk management for that. That is what the risk management is important about. And also actual type of risk management is needed for controlling MTM level fluctuations. You can have an MTM level stop loss, right? So that is also important. This is the actual part of that. You can have a value at risk approach, that if you are losing more than this in a particular month, then you stop trading for that month, right? So there are multiple levels of stop losses approach or risk management approach that you can have. But majorly in this case, for this type of quantitative trading, we require the when we say about risk management, we are saying what would happen if the system fails, right? So that is risk management related to the system. And these are my personal views. So your view might differ, and you are completely entitled to that. But this is what I feel I would do, right? So India really regressive regulation. It is getting regressive every day. As I mentioned, there is allegations against the SEBI chairperson, and Indian government says they are not going to investigate that. That I feel bring national shame for India. But that is how, unfortunately, today that is the state of India. We can't help that, right? So India is bringing few regressive regulation, and already the regulation that is present is also quite regressive. So opening a HFT firm or trading desk or hedge fund is very difficult. That you need to probably go to Singapore or Dubai to create a firm, and that is much more easier. And then you can operate as an FII, right? And you also do not have to pay tax. So that is something you can explore if you have fund, right? At least I am going to do that in future, right? I have not reached the stage yet, but when I reach the stage, I am going to do that. So because of that, I feel what you should do is, if you have really acquired the skill, then float your company and sell algo of those, like what you have created to this firms who can purchase this from on a very high price from you. Because if you can show those profit or numbers, right, then you can sell your algos to these firms. You can uh, make a lot of money, right? And also you can also work for yourself. You can earn your own money. Like few people I have seen, like if you are in Twitter, or which is known as X, if you have some corpus, you can see these people are also creating their own algos, which for them, once again, are execution algos that are based on weak quantitative trading concept, like price action or something like that, which we all of us uses, right? Then you can also work for yourself, create your own algo, right? And then if some retail people also want to purchase your algo, then also you are going to make money. So that is how you should work. I don't believe that you should be working for a HFT or trading desk if you have the skill set, and especially if you have the corpus, right? If you do not have the corpus, then that's a separate thing. But if you have the skill set, what I have mentioned, why should you work for someone else? You should work for yourself, and you should earn money for yourself, right? But in case you want to have some experience, right, and that is also very very important, then only initially you can uh, work for such firms, right? Otherwise, working for such firm to generate money for them based on your knowledge, where you have very easy access to the market, I don't believe that is sensible, right? These are my personal views. Obviously, 99.99% people, especially the actual people, today, what I've seen, or maybe also earlier, they do not have that risk taking ability, or for the lack of better word, they do not have the guts to kind of leave job and create something of their own, right? And that is the reason they look for job. And I have already mentioned what skill set you need to get jobs, right? And then you should not follow SP5, SP6, and actually you should do probably a CFA or FRM. I will prefer FRM, and then do maybe, and can maybe an MBA, and get good CAT percentile, do an MBA, or get good GMAT percentile and do an MBA, right? So I think that will help you, instead of, and that will be faster as well, right? Clearing FRM will not take much time. Clearing CAT or MBA is a 2 years thing, or maybe 3 years thing if you fail in the first year. So you can do it much more quicker as compared to actually. And as I mentioned, traditionally actuaries are not hired in this role, right? Until unless I create my own firm, I don't think that is going to change in future. So if you are working, if you want to work in this domain, probably, and if you are from IIT and IM, then you already have an edge over others. If you are not from IIT and IM, then do a financial degree, then do an MBA, and that try to do that from IM, then you will have, you'll probably cancel some of the edge which others have over you. Right? So I think that's it. This is the deepest knowledge I feel you'll get in the world of quantitative finance. I don't think there is any other YouTube video which gives you this much of depth on this. I've been doing this research for years and years. I can still go on hours about the regulation and everything because I know all of this by heart, right? But I don't think you need that knowledge. So if you have any question and answer, please leave it in the comment section and I can answer that for you, or someone from my team can answer that for you. And please like the video if you believe that this has helped you in some way. Please share this video with your friends because, as I mentioned, many people have asked this. So I think many people are interested in understanding about quantitative finance. I know the size of this video is large, and I hope that you have the patience to, kind of go through this entire video. And that's it. I hope you have a good weekend and good life ahead. Please visit the Blue Dragon Universe website. Please see our LinkedIn page. Lot of activity, lot of interesting and beautiful activities happening there, right? And if you are an actual student, check out our courses. If you are a trading person, check out our courses, right? And I'm also planning a trading, course, maybe live trading course, like where trading workshop sort of thing, maybe in October first week. But I'm not clear on that yet. Depends on my workload. So if that happens, you also get to know in our LinkedIn page, right? So see you in future videos.